Hi, this is Randy Finney with Right Side of the Chart. This is a closing market wrap for Wednesday, August 26, 2020. What I'll do is a very quick update on gold, silver, and the mining stocks. I did an update earlier today, so not a lot has changed since then, but I'll hit on that. And then just talk a little bit about the broad markets. They continue to do their thing. They remain above trend on the daily charts. Some somewhat interesting developments to note today, and just want to do a recap on some of the sentiment measures right now that are really at pinning some extreme levels we haven't seen, depending on how you want to look at it, maybe ever. So we'll get to those towards the end of the video. All right, this is gold. Here's the gold daily chart. So what happened today was a little bounce in gold. Again, it was technically induced. The US dollar was at trendline resistance, failed to break out, has moved down. And that drop in the dollar gave a boost to gold. So when you look at it, the daily chart, here's a trend line I've had for quite a while, and support zone. So this is what the story on gold. It continues to hold this support zone right here. That number is about 179.33 up to about 181.19. There's your support zone defined by this gap right here. Several reactions, and that's it. However, on the flip side, so while gold held support and rallied off that support today, it also ran into that trend line, which is resistance. That's a back test. So that's what it looks like on the daily chart. Probably a little too early to put a downtrend line here. I'd like to see another reaction first. And again, it's going to be, I think, mostly about what the US dollar does in the very near term that will determine if there's going to be much more upside, or if we turn around and resume and come on down here to that next potential target, about 168.70. Weekly chart, nothing's changed. This is the long-term weekly chart of gold showing the last bull market blow off top back there, 2011. And this was that momentum fueled overshoot. So here we are several weeks after that. So gold continues to struggle with that resistance area, that previous reaction high. PPO starting to roll over. We're still at oversold, overbought conditions right now. Came off the extreme overbought conditions recently, and again, I'm still favoring more downside to at least down here to this trend line, and maybe that 173.87 level comes in around the same level. Weekly chart, since we're on that, we'll look at silver very quickly. Same story there, not much to update. This is long-term resistance we're at, defined by a lot of these reactions back here in 2010, 11, through 2013. Big gap in early 2013, a reaction from below, and that's that major resistance zone. We had a brief momentum fueled overshoot, but that so far put the brakes on the rally in silver. As you can see, it's now 4 weeks trading around there, and we're still at within that resistance zone. Daily chart, look at this. Have this level here. This line's not super well defined, so I don't want to put too much stock in it. There's a little bit of a potential downtrend line right there in silver, and we might even be able to draw an uptrend line here as well, kind of given this triangle we're pinching in. That's it. So be my preferred scenario. Still see us coming down here to that uptrend line right there, and possibly that 21.47 level below. But again, it's all about the mighty dollar. Here's DX, US dollar futures. Again, this was updated earlier today, so I won't spend a lot of time there. This is the primary downtrend line I'm watching. Lots of reactions on that trend line, including recently as well. And so far today, tried early on, tried a little attempt to pop it, but couldn't do it and fell back down. So that was this drop in the dollar, which was bullish for gold and silver. So where do we go from there? Well, we're still close enough. I mean, we can come on down, as I talked about. We could extend these divergences. We could make a marginal new low, and anytime soon, those divergences are still going to be intact if that happens. So now, if it does, that's going to give the dollar, or I should say gold and silver, an additional boost. But we could also turn around and break out anytime now. So that's what I'm watching, a break of the trend line and that 93, 191-ish level, take us up to 93, 954. If and when that happens, that would be the initial target. And then a bigger resistance level right there, very important. If that pops, which ultimately I expect it does, that takes us all the way up here to 95,676 or so on dollar futures, and that would constitute a pretty big drop in gold most likely if we get that. Okay, the big news in the stock market today was mostly the FAANG stocks. It was all about that. On face value, QQQ looked good. Even SPY up 1%. Still remains clearly above the trend line. So on the more significant daily chart, when I say significant, this is swing traders, investors, trend traders. These are the signals you want to see. We remain clearly above the trend line in both SPY and QQQ. But what was interesting to note today is the tremendous bid. It seems like a big FOMO trade, a fear of missing out with those FANG stocks right now. People can't get enough of them, and they lifted QQQ up 2.13%. Again, QQQ is not a very diversified. It's just a very tech-heavy index. In fact, investing.com recently changed the NASDAQ 100 futures. They call it the Tech 100 index. That's what they refer to it. If you use the investing.com app, it's got a great smartphone app. You can track futures in the morning, after hours, if you're away, and also, of course, their desktop site as well. So this is QQQ up again, impressive 2.13. But let's look under the hood, and that is largely due to the FANG stocks. So we go back to the S&P 500, which is more diversified, but it's still a market cap weighted index, so it still has a big impact on the FANGs. They're also the largest holdings in SPY. So 1%, less than half of what QQQ did. But now when we dig under the hood a little bit, you look at RSP, which is the equal weighted S&P 500. That was actually, it wasn't even up a little bit, it was down. And that is reflective of the fact that 280 of the stocks in the S&P 500, more than half, traded down today. So we had horrible market breadth. Similar things we had, I think it was, I looked earlier and I can tell you now, I have to look at another monitor on QQQ, which I just loaded. I'm doing this on another monitor. I look at all the components and I can count how many are down. They had 32 out of the 100 or so companies in there traded red today. So a third of the stocks were down while the Qs were up 2.3%. That is very poor breadth. And again, you can see it here. Well, I can do this for you. Yeah, I can go like this, pull out all the components here, and I've shared this in the past. This is a method I came up years ago to how to get real-time market breadth on any index, any sector, things that are normally not even provided, even if you pay a fee to the exchanges to get that. To do that, you just sort like this. So here's all the components of QQQ. There's 102 items in there because a couple of them have different share classes, 2 different share classes. And so what you do is you scroll down and click on the last of the green ones, and right here it tells me 68 of the 102 were up. 69 of those were up. And then again, I did the same thing in the S&P 500. You go to SPY, go down here. You can do it either way. You can count the number of green ones or sort by the losers. You can go down and click on the very last one that's red and percentage gains, which is right here, SWK, and that tells me 280 out of the 505 stocks. Again, you have a couple share classes like Berkshire Class A, Berkshire Class B, same thing with Alphabet, and then 3 were unchanged, so that gives you the rest were up. And so again, it's representative in RSP. You can see the equal weighted NASDAQ or S&P 500 down today. You had the Dow also, has an impact with somewhat on those names, but not nearly as much. And the Dow was up only 0.3%. Small caps, interesting. Well, not really. It's again, this was a large cap tech rally day. And you can see IWM was down, 0.75% or 2/3% today, down 0.63. So let's look at that real quick, because we did have some on the 60-minute charts. We had some sell signals last week on the indexes, and the one small cap so far is playing out. It's been stair-stepping lower. Again, you don't have the impact, any of the FANGs in here. These are the opposite. These are small cap companies. Those are your, mega, multi-billion, even trillion-dollar companies in there. So that's what the rest of the market is doing. And then what stands out to me a lot, let me see, I was waiting to get an update on this. Stockcharts.com will update some of their end-of-day charts each day after the market closes. Well, we don't have it yet. Let me just refresh that one more time, make sure. No, so this is through yesterday's close, but here's something I've covered recently, and I wanted to hit on it again. Just this extreme reading in sentiment. And again, these are the put to call ratio. I like to say I think is one of the most accurate sentiment indicators. You can look at the AAII bull bear spread or the bull bear ratio. They poll people to see how bullish or bearish they are in rhetoric. They just check a box where they think the market's going and 3 to 6 months, but that doesn't mean that they're positioned that way. This is how people are positioned. This is a direct measure of the ratio of put buying to call buying. And again, I've shared it many times. These are the biggest drops in decades. These 56% bear market. Very few. These are the only thing close to whipsaw signals, these readings here. And there were corrections along the way, and I'd venture to say that those were both at least high single digits to low double digits. But other than that, if you look at every other one, these big drops, 18, 21%, of course, that 56% bear market, 10%, 16%, 36%, were all triggered. This one you had a double tap just shy of my red line, that level there, and that was well beyond a 10% drop there. And it didn't get each and every one. There were other technicals that got us short on this one and also got us short there in conjunction with this. But what stands out to me, and I'm sure today we're probably going to see another low reading, is just this persistent cluster. I talk about these either one and done readings like that right there, or a cluster, and where you see extreme bullishness for an extended period of time. And we can also look at what I think I have it on another chart here. You can see behind here, I've got all these annotations over there. I put an 50-day moving average on there too, and you can also see, I think you can in the video make this out, that you can see the 50-day moving average coming down to around this level right here where it's at, and that's where we are. I have that text box right there covering it, but the 50 days way down there. In fact, we can look at one other one here. Let me look at the CPCE. So this is the total put to call ratio index, and then CPCE, I have it down here. This is your equity only. So for example, Apple, Tesla, Netflix, all these things that are pushing the market up right now. And you can see the same thing here in this one without fail. Again, this is, to me, there's no perfect indicator out there, but this one's darn close. When you hit my red line, it's the same level I've used for years. The biggest corrections have come throughout since the bull market back in 2009 began. These are the big drops, and they're not just, in this case, the market plateaued for a while. Then the drop came, so you could have used these effectively if standalone get out of your long or standalone short indicators. But I don't do that. I wait for conjunction, sell signals in conjunction with this, such as trend line breaks, chart pattern breaks, things like that. That one came pretty quick, the drop. Again, this one plateaued, market traded sideways, slogged around for a few months. Then the big drop came. This was a one and done reading, pretty good. That had to be easily double digits there, and then boom, double tap. And again, we'll probably see this. If this continues for a few more days or a few more weeks, we'll probably get another reading there. So you can see that cluster of readings right there. Here, I'll zoom it in a little bit for you, if I can, and drag this over. Yeah, there it is. So 1, 2, almost a third there, and we'll see if we get a third tag of the red line. If we don't have a correction, significant correction, tradable correction within the next few months, well, I can say again that'll be a first, at least for over a decade now, that we hit that level, and it wasn't followed by either the market plateauing and then correcting or an immediate correction. So for the time being, we just watch those FAANG stocks. They're doing more and more of the heavy lifting, as I'm talking about for weeks now, showing you continued deterioration in internals. And you also see that with RSP going back to the S&P 500. You talk about the new highs recently, taken out the pre-COVID highs in the S&P 500. Well, here's the equal weighted S&P 500, still about, what is that, 7% off the all-time highs back from in February. So again, it's the impact that Apple, Amazon, Facebook, and the likes have on the indexes. So we have to watch those guys, and to watch those, we watch the tech sector. Similar trend line there in blue. We watch XLC because XLC is really just Facebook and Alphabet. They make up. That was back then. I haven't updated this since June, but they made up 44%, just two stocks, 44% of this sector ETF. That's one of the 11 sectors in the S&P 500, and a big one. So same thing. You can see very well-defined trend lines. So, I talk and talk and talk about these red flags. When will they manifest in the form of correction? Well, when we get these trend line breaks, and the same thing, ditto for all the 5 FAANG stocks. And here's what those 5 things look like. We'll wrap it up here. I haven't done many updates on those lately because there haven't been any updates. And something's going up, up, up. Fear of missing out trade. Again, it's not my type of trade. I don't see objective entries on these. I see stocks that continue to go up without really any resistance levels or bullish chart patterns, or even continuation patterns for that matter, pan out. But it's those blue lines I'm watching. You can see the blue lines. That first one was Apple. There's Amazon. Same story. These divergences down below just continue to build and build and build as these stocks go. They have not been taken out yet, at least not on the majority of those stocks. And that just indicates that when the turn comes, a very crowded trade, it just puts into perspective just how much downside is going to be most likely the next drop. And there's Microsoft right there. There's your blue line, and also a nice price support level below. You can see that about 201.35 so support as well. And then Alphabet, blue line right there, needs to be taken out. So all these are well above trend. And the one thing is, when the tide turns, it can turn fast. Sometimes you have a slow top. When you get a sort of almost, this isn't a parabolic run yet in these stocks, but it's certainly a it has the feel of a blow off top, but we don't have very high volume yet. Can't say at this point in time it is a blow off top. If we get a little more evidence, maybe so. And we'll look for things like reversal candles, but that's it. And I'm just going through a few others within the NASDAQ 100, like Tesla and all that. So you can see they're all above trend, and those are the lines that we need to see taken out. And when they do, you'll probably see, and you do want to see a majority of those break, not just one, but you want to see at least 3 of the 5 FAANG stocks break down, and then that's when the trend will change. Until then, I won't do, I'll cut back on my updates on the broad markets. I'll continue to focus where the money is to be made. Commodities, I'm not going to update today because they were pretty much flat across the board, most of the ag commodities. So those are the things I continue to watch and trade: precious metals, commodities, and any other sectors or individual stocks that stand out. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.